Ever felt like investing is just about luck, or that you need to be a genius to pick winning stocks? Many people feel behind or overwhelmed, hesitating to even start. But what if I told you that true investment mastery isn't about magic formulas or guesswork, but about four simple, logical principles? We're about to demystify investing with the four pillars that can transform your financial journey. Most people treat risk like a monster under the bed, something to be feared. But here's the secret. Risk isn't about fear. It's about preparation and smart planning. It's the single most important pillar in investing. Think of it this way. Successful investing is like driving a car. You don't avoid driving because accidents can happen. You learn the rules, wear a seatbelt, and drive defensively. The same applies to investing. Here's a simple example. If you put $1,000 into a single stock and it drops 50%, you've lost $500. But if you spread that same $1,000 across 10 different investments of $100 each, even if one completely fails, you've only lost $100, just 10% of your total. Always have a plan. Before you invest in anything, ask yourself, what will I do if this goes up 20%? What if it goes down 20%? Having a plan removes emotion from your decisions. Start small. Never risk more than 1 to 2% of your total investment money on a single trade. If you have $10,000 to invest, don't put more than $100 to $200 into one stock until you gain experience. Practice. First, use a virtual trading account. Think of it as a driving simulator for investing. Most brokers offer these for free. Practice your strategies without risking real money first. Important note: all investing involves risk, including the potential loss of principal. Never invest money you can't afford to lose, and consider consulting with a qualified financial advisor. Have you ever noticed how people panic sell when the market drops, then buy back in when prices are high again? That's emotions driving decisions, and it's the quickest way to lose money. Here's a real example. During the 2020 market crash, many investors sold everything in March when the market was down 30%. Those same stocks recovered and hit new highs by the end of the year. The investors who stayed calm and stuck to their plan saw their money grow. The key is changing how you think about market movements. Instead of seeing a stock drop as bad, think of it as a potential opportunity, like your favorite store having a sale. Create investing rules and stick to them. Write down rules like, I will not check my investments more than once a week, or I will not sell during market panics. When emotions run high, follow your rules. Think like a business owner. If you owned a pizza shop and one slow day happened, would you sell the entire business? Probably not. Apply the same long-term thinking to your investments. Keep learning. The more you understand about investing, the less scary market movements become. Set aside 30 minutes a week to read about investing basics. Here's where investing gets really exciting: the power of time and compound growth. Einstein reportedly called this the eighth wonder of the world. And here's why, with a simple example. If you invest $200 per month, starting at age 25, earning an average 7% return, the historical stock market average, you'll have over $1.3 million by age 65. But if you wait until 35 to start, you'll only have about $610,000, less than half. That's the power of those extra 10 years. Warren Buffett bought Coca-Cola stock in 1988 for about $1.3 billion. Today, Coca-Cola pays him over $700 million per year in dividends alone. That's more than half his original investment every single year. That's compound growth in action. Start now, even small. Don't wait for the perfect time or until you have thousands to invest. Even $25 per month invested consistently can grow to significant amounts over decades. Focus on income-generating assets. Look for investments that pay you while you own them, like dividend-paying stocks or real estate investment trusts, REITs. This creates cash flow that can be reinvested for even more growth. Be patient. Wealth building is like planting an oak tree, not growing grass. The biggest gains come from holding quality investments for years, not months. Successful investing isn't gambling. It's running a business. And like any good business owner, you need to do your homework before making decisions. Think of it like buying a car. You wouldn't just look at the color and price, right? You'd check the engine, look at the maintenance records, maybe take it for a test drive. Investing works the same way. Here's a simple example. Before buying Apple stock, you'd want to know, are they making more money each year? Do they have more cash than debt? Are people still buying iPhones? This is called fundamental analysis, checking the company's financial health. Then you'd look at the stock price trend. Is it going up, down, or sideways? This helps you decide when to buy. This is technical analysis, timing your purchase. Learn to read basic financial information. Start with simple metrics like whether a company is profitable and growing. Most financial websites show this information clearly. No accounting degree required. Buy value, not just popular names. Look for companies that are profitable, growing, and trading at reasonable prices. Sometimes the best investments are companies you've never heard of. Diversify your approach. Don't just buy and hope. Learn about different ways to generate income from investments, like dividend-paying stocks or index funds that spread your risk across hundreds of companies. Advanced. Note: as you become more experienced, you can explore additional strategies like covered calls or cash-secured puts, but master the basics first. Always understand any strategy completely before using real money. So there you have it, the 4 pillars of investing. It's not about finding a magic bullet or hoping for luck. It's about managing risk intelligently, controlling your emotions, leveraging the power of time, and approaching investing like a smart business decision. Remember, this is educational content, not personal financial advice. Always do your own research and consider consulting with a qualified financial advisor before making investment decisions. This journey empowers you to make informed decisions and build long-term wealth, one intelligent step at a time. Your financial future starts with your very next decision. Are you ready to take control?